At the last lecture, we have discussed how to analyze a company's historical profitability using financial ratios. These ratios use a combination of two accounting numbers. For example, we have taken earnings from the income statement and we have divided them with equity from the balance sheet to obtain ROE, the return on equity. At the upcoming lecture, we are going to discuss how to value companies using comparable multiples. These multiples are essentially also financial ratios, but they use a combination of one capital market number and one accounting number. For example, the price to earnings or the PE ratio is defined as price per share divided by earnings per share. Price per share is taken from capital markets and earnings per share is of course taken from accounting. When exploring the menu of valuation approaches in the beginning of this course, we have concluded that comparable multiples are one of the simple or quick and dirty methods that allow you to roughly estimate the value of an asset based on prevailing valuations of similar assets. When using comparable multiples, you basically let somebody else's assessment of similar assets guide or actually determine your valuation of the target asset. The procedure involves computing how much other people are willing to pay per unit of fundamental of a similar asset, and then using this ratio to infer the approximate value of the asset that you value. When using comparable multiples, the key challenge is to find an appropriate measure of the size of an asset's fundamentals that can be used to scale the price. This task is relatively easier in real estate. In the very beginning of the course, we have discussed a case of a developer who constructed an office building in the city center and was looking for ways of valuing it. Office buildings are relatively similar in the service they provide to the customers, and so the developer can observe prices of similar buildings that were sold recently and then convert them by scaling by square meters of the floor area. However, the task becomes more challenging when we start considering companies. Companies are much more heterogeneous than office buildings, and therefore it is not obvious what should replace the squared meters in measuring the size of the fundamentals in companies. It should not be surprising that the accounting numbers reported by companies may be good candidates for these measures of the size of a firm's fundamentals. Accounting is intended to capture the most important aspects of the firm's economic reality. And therefore, if accounting is of some value, the resulting numbers should provide some measure of the economic size of the company. However, not all accounting numbers are equally suitable as a basis for the measurement of size. And therefore, we need to make some choices as to what accounting numbers will be most appropriate to measure the size of the fundamentals. When looking for the right accounting number, we are essentially trying to identify a measure that is a good proxy for the magnitude of the company's base to generate future cash flows. Therefore, it is quite natural to look at the result or output numbers in the key financial statements and use them as the proxy of the company's fundamentals. In the income statement, this function is performed by earnings. Earnings are the bottom line number in the income statement, and so essentially they can be seen as a result of the company's performance in a year after taking into consideration all the revenues and all the expenses the company generated over the year. In the balance sheet, a similar function is performed by equity. Equity is the residual stake of the owners in the company, and it is defined as the difference between assets and liabilities. You may remember from the accounting class that accounting standards have a very precise definition for an asset and a liability, but very vague definition for equity, because they want equity to be just the difference between assets and the negative assets liabilities. So equity is just the net assets. It is the worth of the company for the owners. So net income or earnings and equity are the resulting numbers of the income statement and the balance sheet. And these two will indeed be two good measures that are used as a basis for measuring the size of the company's fundamentals. And this brings us to the first two valuation multiples that use equity and earnings as the scaling factors or as the proxies for the size of the company's fundamentals. The market-to-book ratio is defined as a ratio of the market value of equity to the book value of equity. Market value of equity is also called the market capitalization or the market cap, and it is defined simply as the share price multiplied by the number of shares outstanding. The book value of equity is simply the value of equity that we used in accounting that is taken from the company's balance sheet. So we can say that the market-to-book ratio essentially compares two ways of measuring or estimating the value of the owner's stake in the company. One of them is based on the accounting principles and accounting numbers, that is the book value of equity, and the other one is based on the independent market assessment of the company's value. And the interplay between these two measures will be very important for how this ratio actually turns out. The second ratio uses earnings or net income as the scaling factor. It is the PE ratio or the price to earnings ratio, which is typically defined as the price per share divided by the earnings per share, which is equivalently, of course, the market value of equity or market cap, equivalent to the measure here, divided by the total net income or earnings. The PE ratio essentially captures how many times the level of today's earnings the investors are willing to pay for the company. And that's why this measure is called a multiple. And this brings us to the first question of today. Of course, both equity and earnings have some advantages and disadvantages as measures of the magnitude of the company's fundamentals. And therefore, the resulting measures, market to book and price to earnings, will also have some pros and cons. In some contexts, one of these measures will be more suitable, and in other contexts, it will be the other measure. I want you to discuss the two measures, compare and contrast them, and then discuss in what contexts will each of the two be more appropriate, more suitable to value firms. And then, as a follow-up question, I want you to observe the close connections between market to book and price earnings. In fact, if we have the market measure here at the top and the book measures here at the bottom, then we have already defined ROE as the ratio of net income to book value of equity. And today we are defining two additional measures, that is to say the market value of equity to book value and the market value to the net income. And I want you to compare two of the three measures, the market to book here and the ROE there, and discuss what aspect of the company's profitability they represent. The interpretation of the market to book ratio crucially depends on the understanding of the similarities and differences between the market value of equity and the book value of equity that constitute the numerator and the denominator of that ratio. And therefore, in a related multiple choice question, I want you to discuss in what relationship will the two ways of measuring the company's equity be. Will one of them be higher than the other? Will they be similar? Will the relationship depend on some other aspect of the company reality? I make two assumptions. The first one is that the company is not distressed. It is just up and running. And the second assumption is that it is a non-financial company. So it is not a bank or not an insurance company. That is because the accounting in banks and insurance companies is rather different from the accounting in normal traditional firms. When we look for the appropriate scaling measure, we are essentially trying to find a measure that best captures the magnitude of the company's base to generate future cash flows. Cash flows are the major determinant of firm value, and therefore the more free cash flow the company is expected to generate in the future, the higher should be its value. The question is, what aspect or what measure of the production process best represents the company's ability to generate cash flows in the future? And these are the individual steps of this process. Companies typically start with generating some customer interest and some capacity to produce. Then they generate sales. From sales, hopefully they retain some operating profit, and hopefully some of this operating profit is left in the company even after paying all financial expenses, and then the earnings become part of the book value of equity at the end of the year. So this is roughly how the flow of the production process proceeds. Now the question is, which of these steps best represents the company's ability to generate future cash flow? Now we have not discussed cash flows yet, but you may know that cash flows are computed from EBIT, the operating profit, that is adjusted for taxes and adjusted for cash outlays needed to maintain and extend invested capital. And therefore, it is quite likely that the right numbers, the most appropriate numbers capturing the magnitude of the company's base to generate future cash flow, will be found somewhere here in the middle of that process, because they are quite close to the actual cash flows. So it might be the operating profit or it might be net sales, because companies that generate a lot of sales typically will be able to provide good free cash flows in the future. However, here in the middle, there is not one, but there are several measures. And the difference between them is significant, and therefore we will need to make some choices as to which of these measures we want to use as a scaling factor in our comparable multiples. And this brings me to my third question of the week. The third question asks you to discuss the strengths and weaknesses of the following 4 valuation multiples that are all rather close to cash flows. That is to say, the enterprise value to net sales, the enterprise value to the earnings before interest, taxes, depreciation and amortization, the enterprise value to earnings before interest, taxes and amortization, and the enterprise value to earnings before interest and taxes. Please first study how they actually differ, and then discuss how these differences impact on the ability of these 4 measures to capture the magnitude of the basis the company has to generate future free cash flows. In a closely related multiple choice question, number 4, I want you to use the takeaways from answering the previous question to make your choice between 3 of these measures. I have removed the rather popular enterprise value to EBITDA, and I ask you to choose the best out of these 3 to value a mature and relatively stable company. So if you are in this setting, would it be best to use the enterprise value to net sales, enterprise value to EBITDA, or the enterprise value to EBIT? And this brings us to the end of this lecture prelude. These people are apparently using a rather sophisticated technique to determine their scaling measure, EBITDA. And that actually happens sometimes in real firms. These adjusted earnings are sometimes referred to as the pro forma earnings, and companies produce them because they believe they better represent the underlying fundamentals. Now, I want to point out that comparable multiples are a simple measure of valuing companies. And sometimes people try to make this simple measure more complex by making the EBITDA computation more complicated. I believe that effort will mostly be futile, because the multiple will never capture the entire complexity of the value generating process in the company. So if investors want a valuation technique that is more sophisticated, I suggest they do not devise more complex ways of defining the valuation multiples, but instead they use a technique that is best adapted for a sophisticated valuation approach. And that is the discounted free cash flow model, which we are going to cover after concluding our discussion of comparable multiples.